Hello, everyone. All right. So today I'm going to be going over something that is a critical part of strategy. So it's technical analysis, but more from strategic point of view. So um, so let's start. All right. So one of the first things that you taught in technical analysis, which is BS, is this. I wouldn't say it's BS, but it's a highly oversimplification. So this is a oversimplification. So it's simplified to the point where it just doesn't work. Meaning, the only way this is going to work is in hindsight and on higher time frames with big wave retraces that don't really look at what all of the price action. So anyway, this is oversimplification, and it makes a major assumption. What is the assumption? It assumes, this is the biggest flaw in it, all right? This model, which we all are taught and is in every book about trend, has a major flaw and assumption, and that assumption is that is the assumption. So basically, when price goes above this, it's going to go. When it goes above this, you're going to have movement. When it goes here, you're going to have movement. And that's the flaw. And one may say that it's because this is a logical conclusion, because the assumption in this model is every breakout works. So if every breakout works, if you accept that assumption, then you're going to buy the breakouts. And this, now I'm not saying this never happens. It happens, but it's in a very strong state of momentum where it's totally one-sided, and that is not the general case. That is the exceptional case. If you open up the ES every day on any time frame, it doesn't look like this. It just doesn't. So I'm going to show something. All right, so first, this assumption, let's consider that this assumption is not true and the scenario in which it's not true. All right. So we'll put a scenario. Doesn't work. And this is the real situation that you see, because we'll assume, what if the breakout does, you know what, forget this. Let's assume something else. What if, what is this? All right. We'll assume both. And some don't. All right. Which is like a more realistic example, right? Sometimes it works, sometimes it don't. So you need to know, what do you do? What's going on when they don't work, right? So for you to understand this, let's say the objective of price is, you know, it wants to go from here to here. All right. So it does this. Okay. Did this breakout work? No. And this happens all the time. This is like the real, you know, what really happens. You open up a chart right now, exactly right now, I'll show you multiple. I mean, more of these occur instead of the breakouts. And the reason is there's a range before the breakout, and that range, the sides, the edges of it always get tested. And the breakout only has to work once for it to enter a new range. So there's a lot more tests in the range. All right, so breakout didn't work. All right. So the breakout didn't work, and the idea here is what do we know at this point? What is the situation? What are the facts? We know, well, one, the breakout didn't work. Two, breakout buyers are stuck and want to get out break even. All right. The breakout didn't, and they want to get out break even. From a market maker's perspective, he's also thinking like, how do I get it up there? Right. So now you have to ask, what can market makers or the CM do? And basically, the answer is really simple. You have to force short covering. If the breakouts are not working, you need short covering. Right? And the other solution is what must the CM do to get price to higher, to get the market right? So what must he do? What must the CM do to get the market to higher prices? Well, first is short covering can lead to higher prices, but there's the other point is you have to get the breakout buyers, the stuck breakout buyers out. All right. Why? Because they want to sell out of their losing positions. So we know that the breakout didn't work, so the breakout buyers are stuck. You got to get rid of the breakout buyers because as price goes back to those levels, they will exit to break even. And if they exit to break even, they will cause selling pressure, which will stop price from going to higher levels. So what must you do? The answer is simple. The only way to get the breakout buyers out and to cause short covering is to make lower lows. and you might have to spring it, right? So to run the stops of the breakout buyers so they're no longer there. You got to get them out. And B, entice shorts to enter and then make them cover. You got to entice shorts to enter and make them cover on the next breakout attempt. Okay? So this is what needs to be done. So what that means, low spring,
order filled.
means that the seller's stops are run, and 2, stops are run, and shorts are in. And when shorts are in, they will cover their position back up here, creating buying momentum. You see? So stops are run. Oh. The breakout buyers, their stops are run, and shorts are in, and they will cover, creating buying momentum. And that is a strategy to create enough pressure for both breakout buyers plus short covering, which can take prices up. Okay? So what you want to do is think from that perspective, meaning from the perspective of basically pressure, and failure. And then how do you overcome that failure? What's the solution? You got to get them out so they don't break even, causing selling pressure, which will prevent prices from going up. And 2, entice new shorts to enter, so their stop will create the covering, which will add to the new breakout buyers that are coming in to take prices higher. So existing stops are out. The breakout buyers that are stuck, they're out here. Let me write that. Stops are run. The breakout buyer stops are run here because their stops were under the prior low. and shorts are in. Short covering plus new breakout buyers can take price higher. So last time you just had breakout buyers, but this time you're going to have short covering plus new breakout buyers, and that can take price higher. Okay. So this is what needs to be done. All right, that's all, folks. So with this in mind, like the problem really is when you're trading, when I'm trading, when everyone's trading, we're seeing things in patterns. Oh, this is a flag. This is a head and shoulder, right? But what this is doing is that it's making you not use your mind about what really is going on in a very basic way. You have breakout buyers. Did they win? No, they lost. Why? It didn't follow through. Where are their stops? Take their stops. Why? To get them out. Why? So they don't have opportunity to cover, creating selling pressure. And entice new shorts. Why? Because we need their short covering. Why? Because their short covering plus new breakout buying is required to take prices to a higher level. Instead of that thinking, we're looking at kindergarten shapes. This is not going to work. This is a disaster. This is fed to you to make trading look simple, easy. Everybody can do it. So give us your money and start trading and running up commissions. And it's basically the term inducement or enticement for you to trade in the first place. This and this, and what is that? The other one. And this are such huge oversimplifications that they are meant to show you that anybody can do it, because it requires nothing. You can be taught this in like 5 minutes. Higher high, higher low, higher high, higher low, higher high, higher low. Oh, it just goes high? Yeah, it just goes high. Higher high, higher low. Oh, it looks like a flag? Oh, it looks like a head and shoulders? Like my head and shoulders? Oh. And this is my neckline? Oh, okay. So you see, like, there's no way this can work, because this is enticement to trade and think you can make money, but in reality, this is a far more complex game. Anyway, thank you. Have a good day. And you want to focus on this and start looking at it from that point of view about trend and what happened. Did it fail? What do you need? Okay, wait for it to get what you need, then start looking for opportunities, etc. All right, take care. Thank you. Bye.